Hi, I'm Siu Ling Hui with part 3 of a video series about how your financials can help you manage and drive business success. In this video, we'll focus on the effect of inventory on the finances of your business. In the earlier video in this series, our working example assumed that you always sold out all the widgets you bought in the same month. In other words, you never had any stock of widgets on hand at the end of each month of trading. Now let's continue into month 3 of trading, but now we build in the effect of holding inventory. Let's say the widgets cost you $10 each and you sell them for $20 each. In month 2, you bought 100 units and you also sold 100 units in the same month. Now, at the start of month 3, you decide to buy 200 units. That costs you $2,000 and you have 30-day credit terms from your supplier. Let's say you only sell 150 units in month 3. That's $3,000 in sales. So at the end of the month, you've still got inventory of 50 widgets left. What are the financial implications? Before we look at the financials, let's set the scene for other aspects of trading during month 3. Of the sales of $3,000, $2,400 was on 30-day credit terms. $600 was on cash terms. During the month, you got $1,600 cash in from your debtors. You paid your supplier on time for the amount owing from month 2, so your supplier is happy to keep extending your 30-day credit terms for the $2,000 worth of widgets that you order this month. Wages stay at $200, and we will still assume that tax rate is 0, so profit before tax is equal to profit after tax. In terms of your profit and loss, the fact that you bought 200 units doesn't impact the cost of sales. The cost of sales is only the cost of the units actually sold. You only sold 150 units. Those 150 units cost $1,500. That's all that goes into the cost of sales. It's in your balance sheet that the 50 unsold widgets show up. The cost of those 50 units is $500, so you now have inventory of $500 in assets on your balance sheet. Although you made a profit of $1,300 and you also got credit terms from your supplier, your bank account only increased by $1,000. Holding inventory ties up cash, just as debtors tie up cash. Let's look at your cash flow statement. The working capital requirements of your business chewed up a net $300 of your cash flow from operations. $500 was used up because you now have inventory that you bought but haven't sold. Although you collected $1,600 in cash from your debtors, you also had credit sales of $2,400. So the net result is that you had an additional $800 being tied up in debtors this month. That's 800 more sales dollars that haven't turned into cash yet. So that makes it a total of $1,300 of cash used up in your business because of having more debtors and having stock on hand this month. But you had net incremental trade credit of $1,000. In effect, your supplier provided you with funding of $1,000 this month. So this reduced the cash flow impact of the buildup of debtors and inventory on your balance sheet this month to negative $300. This gives you net cash flow from operating activities of positive $1,000 this month. As there were no investment or financing activities this month, that's $1,000 is the total net cash flow for your business this month, which is exactly the amount of increase in your bank account. The 30-day credit terms from your supplier help buffer the cash flow impact of buying and holding inventory this month, but your balance sheet liquidity is reduced. I'll go into liquidity ratios in a later video in this series. Right now, let's just focus on cash flow implications of inventory. Holding inventory adds an extra leg of time to what is known as the cash conversion cycle. That's the length of time that it takes from the time you pay for the goods to getting cash into your bank from the sale. In our example, we have to pay the supplier in the first week of March. Let's say the widgets are sold in the second week and the sale is on credit terms of 30 days. That means the earliest you will receive cash from your outlay on the purchase of the widgets will be the second week of April, and that's assuming your customer pays on time. So that's a 6-week cash conversion cycle or working capital cycle. You have money tied up in working capital from the first week of March to the second week of April, first in stock, then in debtors. If your debtor is late in paying you, that stretches out the cash conversion cycle even further. If your supplier is prepared to extend you longer credit terms, that helps shorten the cash conversion cycle. It's vital to manage all elements of your working capital cycle very tightly. Your inventory holdings and your supply chain, your debtors and your creditors. You want your business's cash conversion cycle to be as efficient as possible. Sound inventory management is about striking the right balance between having too little and too much inventory. The advantage of holding enough stock on hand means you don't keep running into an out of stock situation. That could mean lost sales because your customers start buying from your competitors. With a manufacturing business, not having enough of the right raw material on hand could mean disruptions to the production schedules. The downside is that holding inventory ties up cash, but unlike debtors, it's very difficult to get financing against inventory holdings. I'll discuss this financing issue shortly. The other disadvantages are the holding costs, the warehouse space taken up, insurance, security, and so on. And then there's the shrinkage risk issues to consider. Shrinkage means loss of value in your stock due to obsolescence, damage, theft, and so on. And these all affect your business's finances. It's extremely difficult to get financing for inventory. There are a few exceptions like the specialized inventory financing facilities that are designed for specific industries like car or boat dealerships. But outside of those situations, lenders are reluctant to provide significant financing for inventory because of the business risks associated with inventory. These risks are very much risks that can impact your business's profitability and cash flow. Obsolescence is one issue. For example, there's a big difference in the risk associated with a stockpile of white t-shirts versus, say, purple checked miniskirts. White t-shirts are a commodity. They can be sold and turned into cash virtually year in, year out. But if purple miniskirts go out of fashion, then you have to make a decision as to whether you heavily discount them and sell them at a loss just to get rid of them, or hang on to the stock in hope that one day they'll come back into fashion. Taking a loss would at least free up some cash. Otherwise, it costs you rent of warehouse space, insurance, and so on to hang on to them. Even with a commodity like white t-shirts, you'd probably not get much more than, say, 30% of the value of the t-shirt inventory in terms of financing. In other words, a lender might lend you $30 for $100 worth of t-shirt stock. You still have to fund the other $70 out of your own cash flow, and even that minimal level of financing would be subject to a whole bunch of other conditions. Seasonality can also affect the realizable value of the stock. If, for example, you were holding a large stock of woolen sweaters at the end of winter, what do? Sell them at a discount to free up some cash, or hang on to them until next winter? What will it cost you to hold on to the sweaters? There are also other shrinkage issues like theft of stock or damage whilst in storage. From the lender's point of view, they want some way to control the stock as well so that the money goes to them as soon as it is sold. Let's go through a simple example that shows what happens with a highly seasonal business over a 6-month period. The product is something that only sells in months 4, 5, and 6. But you need to start getting stock in over months 1, 2, and 3 because your supplier can't produce all of this product in one hit. And you want to make sure you have enough stock so you can maximize sales for the season. Your supplier gives you 30-day terms. You get 1 pallet load in month 1, 2 pallets next month, and another 3 pallets in month 3. But you have to keep paying your supplier within 30 days for each delivery. Your customers start taking stock from you from month 4 onwards, 2 pallets in month 4 and the rest in month 5. But you have to give your customers 30-day credit terms as well. So the sale of those pallets become debtors in the month of sale. You don't get the cash until the following month. Note how much cash has to go out the door to fund inventory before you start getting cash in again. Let's look at what your financials would show. To keep this simple, I'm using abbreviated views of the financial statements. First, the profit and loss. Let's assume that your business does nothing else except sell this seasonal product. So you have no sales until month 4. We'll also assume you have a wages bill of $200 a month for the entire 6-month period. No alarm bells in the profit and loss. Yes, there are small monthly losses in the non-selling periods because of the wages bill, but that's to be expected. It's a profitable business. In 6 months, you'll make a profit of $4,800 from $12,000 in sales. That's a 40% profit before tax margin. Now let's look at your balance sheet. I've assumed we start off with a balance sheet with 0 balances just to keep things simple and to more clearly illustrate the financing requirements with inventory. You can see inventory increasing over the first 3 months and then reducing as you start to ship stock to customers from month 4 onwards. That's when your stock goes down but debtors increase. Your supplier gives you 30-day terms for each shipment, so trade creditors increase with increased buying over the 3 months. But you also have to pay the amount owing each month in the following month, or your supplier could cut supply on you. Look at the bank balance line. It gets progressively deeper into the red as the inventory buildup is happening. You can't actually have a negative bank balance. You've got to find the money to cover that shortfall. This example is just to demonstrate the financial impact of the cash conversion cycle with inventory. The cash flow statement shows you very clearly the funding requirements of this seasonal business over the 6-month period. The peak working capital funding requirement for this 6-month period is $6,800, and that happens in month 4. The net cash flow from operations line tells you how much cash your operating activities generate or use up each month. To figure out how much money you need to find to cover this seasonal funding requirement, you need to look at the closing bank balance line. This is the line that shows you the cumulative impact of each month's net cash flow on your bank balance. That's the net cash flow of everything that's happening in your business: operating activities, investment activities, and financing activities. In this case, it's only operating activities that's involved. There are no investment activities, and we haven't incorporated any financing activities at this stage. In this example, we started with a zero bank balance, so that peak funding is exactly equal to the cumulative net cash flow from operating activities. That's the $6,800 in month 4. If we had started with, say, $5,000 in the bank account in month 1, then obviously that would be $5,000 less that you need to find. You would only need to arrange for another $1,800 to cover your working capital funding requirements in this 6-month season. And you only need this additional financing for a month. It's really critical to have a very strong handle on how much you need to fund inventory holdings and figure out in advance how you're going to cover the funding required. This is especially important for high-growth seasonal businesses where there is going to be very high stock build leading up to the selling season. Assess your financing requirements with 3-way financial forecasts. That's profit and loss, balance sheet, and cash flow. Your forecast must reflect your working capital cycle. Decide on a realistic financing strategy to fund your growth and get your financing in place well ahead of time. This is really important because profits don't mean a thing if you can't pay your bills along the way. Failure to plan, manage, and finance working capital needs has killed many fast-growth businesses, particularly those businesses which deal with inventory. If you can't get enough money to cover the growth financing needs, it may be more prudent to slow growth slightly rather than end up in all sorts of problems. Here's a quick recap on what we've covered in this video. Inventory ties up cash. It extends your business's cash conversion cycle. The less inventory you have and the less time you have to hold it for, the better. But having too little inventory means you run the risk of losing sales both now and in the future. Your customers will start buying from your competitors, and you could lose them permanently as customers to your competitors. However, it's hard to get true inventory financing because of the business risks associated with inventory, things like obsolescence and other forms of shrinkage. As a business owner, you must have a very good handle on the working capital funding requirements of your business. If your business is in fast growth and or highly seasonal, and your business involves carrying inventory, make sure you plan well ahead of time to ensure that you can cover the working capital requirements. If you can't get enough money to achieve your growth targets, it may be better to slow the growth rate. If you want more information about business financial reviews, business planning, or about financing in general, please put your questions below in the comments or contact me through the contact page at incontextfinance.com. Master your cash flow, know your finances so that you can drive strong, sustainable business growth and thrive. Thank you for watching. If this has been useful, please like and subscribe to my channel.